Well, first of all, thank you all for joining in today. The topic today is the 3 C's and 5 main plan themes. Our intention is to try and simplify plans so that ultimately you see that all planning tactics are one of the 3 C's and that all plans fall into one of 5 main themes. And the idea is that when you recognize which theme applies, then it becomes fairly evident which of the 3 C's planning tactics should be applied. So let's start with the 3 C's. All planning tactics are based on the 3 C's: convert, create, and conserve. Reducing income taxes is a special form of conserve. And as you can see, the 3 C's are represented in the following graphic. So what we want to do is briefly run through each of these. When it comes to reducing income taxes, clearly all plans should include tax reduction tactics. So let's have a look at VisionWorks for a moment just to identify where those are located. If you're on the Solutions page, Tactics tab, the Tactics sub-tab includes certain tax tactics. Things like transferring donation and medical credits, sharing CPP benefits, and splitting pension amount income. Now, I'll just note for now that there can be a combination of these different things that represent the optimum tax savings. So when you click the Optimize button, VisionWorks will go in. It will try each of the possible combinations to arrive at the optimal combination. On the Withdrawals tab, in the Auto Withdrawals post-retirement period, you have the ability to optimize for OAS clawback or the ability to optimize up to a certain tax bracket level. So for example, if you withdraw money from an RRSP or a RIF in retirement, in addition to, for example, non-registered portfolio income that's taxable, OAS, CPP, VisionWorks will go through, figure out how much to withdraw from that RIF up to, let's say, the first tax bracket. And then if there are additional income needs, it will then begin to withdraw from, for example, the TFSA. So it will always keep the taxable income just below, for instance, the first tax bracket level. One of the things I want to do is just go to the reports and show you which of the sections in the report should be included if you're applying tax tactics. Now, of course, this is going to take a second to load before we can actually look at the report sub-tab. So as you know, with a VisionWorks plan, sections and subsections can be included at your discretion. You may or may not like this whole 3 C's concept, but for now, I've included the graphic we've been looking at, the financial gap in 3 C's, and I want you to notice that I've included the reducing income taxes section. Now, normally you would go in and choose which sections and subsections you'd like to include in a plan. But when it comes to reducing income taxes, my recommendation would be that you leave all of these pre-selected. And the reason is, if a tactic applies, such as the OAS clawback tactic, then VisionWorks will include that in the report. But if a tactic doesn't apply, such as transferring donation, medical, or adoption tax credits, even though it's selected, it won't be included in the report. So the software is intelligent enough to know whether something applies and to include only those things that do apply. So let's have a look now at the next of the three C's, convert. Now you'll notice on the scale that I've said that the impact of this can be very high. So as an example, it might be something like, at some point in retirement, we don't need the large house anymore. We want to do a lot of traveling. We're going to downsize to a condominium, for example. It's much easier if we want to travel. No issues about house insurance and people checking the home and so on. So what happens, of course, if there's a downsize and a capital takeout, that capital is then added to the non-registered portfolio. There are other convert tactics, perhaps selling a business or whatever. And I've ranked these as a high impact because there can be a lot of capital takeout. And I've also ranked them as relatively easy. Downsizing a house is fairly straightforward. Now, of course, we could say that selling a business may not be exactly easy, but I've called it easy simply because it's a lot easier to sell a business than it is to go through the years of creating it in the first place. So again, let's go back to VisionWorks and have a look at the sections we would include. So this would be the converting wealth section. And then, of course, you can either include the asset sales and purchase tables, et cetera, in actual dollars, excuse me, or if you wish, in actual and today's dollars. Let's look at the next C, which is create. And I want to talk about this for a moment because, as you're aware, in most planning, retire later or earn a higher return on portfolios would be the typical create strategies. But you'll notice that we've talked here about earning more. So what I want to do with VisionWorks, just to elaborate on that, is go to entries. And what I've done here is I've created a financial advisory business. The gross income is $150,000. The issue with other software, and we talk a great deal about this, is that the database is essentially what we refer to as static, meaning once you put in an entry, the assumption is that that entry persists over time, other than perhaps some inflation adjustment. In VisionWorks, the database is dynamic, meaning you can take any entry and change it over time. So in other planning software, often the career possibility of creating wealth isn't considered because it's not easy to change career income over time. But if you're dealing with a client, and this is where financial attitudes are very useful, if you're dealing with a client who has a very high work score, then I would suggest it's extremely appropriate to have a conversation about their career path. They're very career-focused people. So let's assume you fall into that category. Your gross income right now is $150,000. And I'm just going to bring up the income assets forecast, which you can see has a very large negative value. And I'm going to assume that over the next 5 years, you can increase your career income from $150,000 to $200,000. So just a matter of, $10,000 a year. And what we want to do now is we want to understand what's the impact of that. So all we need to do is click the Save button, and we'll see the entire impact. We're assuming for now that your expenses remain the same. And the reason for that is when you're creating a vision of life, you should be creating the things that you want to have and do. And then the point of planning is to discover how can we actually achieve that. And what you'll see, of course, is that the negative forecast changes from $600,000 negative to just about $300,000 negative. And all you did was increase your target income by $10,000 a year. So I'm going to refer to this as a very high leverage point. Other planning tactics like sharing CPP benefits and so on, while they do create a tax impact, are low leverage points. So if you're dealing with a client who has some control over their career income and who has a very high work score, I'm going to suggest that having a conversation with them about that is very appropriate. So let's have a look at the report section. And what we want to talk about, of course, here is that reports should include anything that has to do with sources of income. So again, we'll have to let this load for a minute. So there are two things that we would want to do here. One would be creating wealth and then looking at the sources table, which would show that increase in career income. And then obviously, one of the creating wealth strategies that would always apply is looking at people's portfolios and seeing if there are ways that you can enhance returns. So we would want to include the IPS section. Now, I want you to notice that in this plan, I've just selected the total of all portfolios for Bill and Sue. I'm not including individual portfolios. So this is up to you, but my suggestion would be that if we include all portfolios, the reallocation for each, the new portfolio holdings, the returns, etc., we're going to make the plan very portfolio oriented and very portfolio heavy. What you can do is create a plan that summarizes the impact on all portfolios of the changes, and then that keeps the portfolio section a little lighter in the plan. Quite separately, what you could do is deselect all sections, select the IPS section, select each portfolio, and actually produce a separate document that would very thoroughly look at the changes for all portfolios. So let's go back now to our our fourth C really, which is conserving wealth. And clearly it's having a look at people's expenses, what the impact of those expenses are, looking for things they might do to change their expenses, particularly their Latte factor spending. And very often it's their Latte factor spending on money on things and they don't even know where it's going, that actually gets in the way of them achieving the things that they most want to have and do in life. And we'll look a little bit more at this when we have a look at the 5 themes. So, first of all, I'm just going to make a little adjustment to our house rich and cash poor theme. I'm going to exclude that advisory business, and I'm going to re-include Bill's salary income. And we'll now have a look at the house rich, cash poor theme. So this is a theme that I think is relatively common. And what it simply shows is that the net worth projection looks great, but the income producing assets projection shows, in this case, a substantial shortfall. And all that says is people's net worth is increasing, but it's primarily increasing because of the value of their house and their cottage. That they're in fact not saving enough, TFSAs, RSPs, non-registered portfolios, to be able to maintain the lifestyle that they want in their retirement years. So this is a relatively commonplace theme in our society. And we'll talk more about this later, when we relate it back to the 3 C's. But of all of the themes, I would suggest that this is the one where you can apply the widest range of the 3 C's planning tactics. So let's go and look at the next theme, which is large latte factor. And again, I think this is a very commonplace theme. Now, typically in our software, the primary account would act as the primary bank account, and you would set it up to transfer money into the non-registered portfolio where it'll earn a return and so on. But intentionally, I've set this up so that the primary account is acting as a portfolio because I wanted to illustrate this very large buildup in the non-registered portfolio. And you can see quite clearly that it's a significant factor in the buildup of their overall income producing assets. Now, the reason that this is happening, of course, is if we look at net cash, and I'll do total, we can see that in theory, their net cash flow is positive, running more or less around $50,000 a year. So if we drill into net cash flow, we can see sources are 206, uses are 143, for example, next year, the full year. Well, if we look at sources, by and large, for most working people, the sources are very straightforward. It's their career income, generally fairly easy to identify. What's more difficult for people, of course, is to identify their expenses. So if sources minus uses is net cash flow, if net cash flow is looking very positive, if sources are fairly straightforward, then that very positive net cash flow is likely because we've underestimated the uses. So this is, again, of course, very difficult for people, and the reason we call it the latte factor, what it's essentially saying is that people are spending money, they haven't been able to identify where, because it's just going out the door and they really have no idea where it's going. So one of the things that I want to show you is the ability to help clients understand just how impactful their latte factor spending actually is. So if we go to lifestyle general expenses, and again, I'm going to bring up income assets, one of the features that you can turn on for illustration purposes is this spend all excess cash, meaning we know the sources, we have recorded the uses, but what we're thinking is there are a great many of those uses that are not accurate, and in fact, latte factor spending is going on. So if we turn on spend excess cash, that positive cash flow, and click the OK button and save it, what you're going to see, of course, is that we get rid of all of this theoretical savings, and lo and behold, we show a big income asset shortfall. And so interestingly enough, if we spend that latte factor money, then what we're really back to is the theme that looks like house rich, cash poor. So the role now will be to help clients understand the impact of that miscellaneous cash spending, that latte factor spending, and then to work with them to try and capture that. And the training video on the website will look at various things you can do, but they can include, for example, setting up a PAC program where money is coming out of the latte factor spending and going into the portfolio. You could also, for instance, set up an insurance policy where contributions to it are building the cash surrender value, and then ultimately in retirement, if they had a policy like that, you might be able to take a bank loan out later on. So there are a number of things to look at, and the training video will run through those. Let's look at the next theme, which is what we just called net cash. And what I want you to notice about this is that again, the income assets forecast is very positive. There's essentially no issue. The problem for people is that in the short term, they're running cash flow negative. And this is something that is causing them a great deal of anxiety. They may be running up lines of credit or whatever it may be. And the problem for people is that we're living in the moment, we're running cash flow negative, our line of credit is going up, we're getting ever more anxious about money, and they simply have no long-term perspective. So in this particular case, the reason that they're running cash flow negative is because of education expenses. So the child's in university, their income is being obviously strained because of that expense. But we can also help clients see that an expense is something that's just going to last for a very short period of time. And once that period passes, they're going to run cash flow positive again, and their income assets in the long term say that they'll be okay. Now, in this particular theme, other than tax reduction tactics, which should apply to all plans, none of the three themes really particularly apply. Let's look at the fourth theme. And again, I want to remind you that at least in my experience, all planned output, if you are satisfied with the inputs, will fall into one of these themes. This particular theme we call okay to spend more. And predominantly it applies to people who are already retired. So you can see I've made Bill and Sue's current age 72 and 67. And we can see that the income assets forecast looks just fine. They're going to have lots of money. The problem is often people who are retired fear running out of money, and so they're not doing the things that they'd like to have and do. And those things might not just be for themselves. They might be, for example, for children, helping adult children with a down payment on a house, helping grandchildren by, for instance, sending them to summer camp or contributing to their RESP or whatever it might be. So in this particular theme, you have the ability to go to entries and perhaps either change entries like winter vacation amounts or add special vacations or whatever it might be to see the impact on the income assets. And then, of course, if they remain positive, then people will feel much more comfortable about doing more than they thought they could. Now, again, this is a theme where basically, other than tax reduction tactics, none of the three C's particularly apply. The fifth theme we're going to look at is the high net worth theme. And this is, of course, the case where you've got clients who are high net worth clients, and there virtually are no problems. Again, it's a question of of applying tax tactics. The problem very often for the high net worth client is not, will we be okay in retirement? In my view would be that if that's the focus of a plan, the mass affluent to higher net worth client, not even necessarily high net worth, they're going to be okay, assuming that they prudently manage their affairs. But the issue for them is actually an estate gap. And the question is, will the estate have sufficient liquidity to be able to pay all the terminal charges? So in this particular case, you can see that Bill leaves his assets to Sue. We're projecting $500,000 in the non-registered portfolios, but there are significant income taxes that are going to be owed on the cottage. And as a consequence of that, the residue for distribution is negative, and there's going to be a fairly substantial estate gap, an estate charged for those terminal taxes. Now, one of the problems for people in this position, by the way, is that they have trouble relating to value. So remember that the tax we're going to pay on that cottage is going to be the difference between its value at the time of death and its ACB. And the issue is we're not taxed on the real growth of the cottage, we're taxed on the nominal growth, which includes inflationary growth. So I've got a cottage here that's 1.5 million, but if we have a look at it, just over their remaining life expectancy, using a 6% inflation rate or nominal growth rate, which is the long-term growth rate for real estate in Ontario, the value of that cottage is $9.1 million, which is very shocking. Now, part of helping clients understand this issue is that you can switch from actual to today's dollars, something that they can better relate to. So in today's dollars, taking out the inflation impact, we can see that the assets in the will are then just 4.8 million, but including the inflationary growth, 12.2. So that can help you with the higher net worth client understanding what the source of that issue actually is. So what I'd like to do now, so let's go to the report. Again, it'll take this a second to load. So clearly in this particular case, while we can include income asset forecasts and things like that, that just say you're going to be fine in retirement as far as your as income assets are concerned, the ability to meet your spending needs. Clearly, what we want to include in this report would be things related to their estate issues. So who are the beneficiaries of the wills and so on, and then an estate summary, which will actually break down the residue for distribution, the forecast of the estate value. That's going to be what's most important to these people. So let's go back to solutions, and I'm going to actually bring up the House Rich Cash Poor solution. Remember, it's the one that we can probably apply the most tactics to, and we'll actually look at a few different tactics. I see I didn't spell allocate correctly. So we'll look at a few different tactics. So once again, if we have a look at the forecast, the House Rich Cash Poor theme, net worth looks okay, income assets show a shortfall. So what we've been talking about is always applying tax tactics. So let's go to the tactics tab, and we'll actually apply tax tactics. And again, all we need to do is click the optimize button. And VisionWorks will go through all possible combinations and figure out the optimal combination that should be applied for the Smiths. And of course, because it has to actually go through and check each of the combinations and check the tax impact over the course of the plan, it does take a bit to process that, but not, overly long. So you can see here that the optimum tactic for them is splitting pension income, that they'll save taxes of about $8,000, but they'll also save about $3,500 in OAS clawback. So there's a net impact of $12,000. Now that may not look like an overly large amount over the retirement years, but nevertheless, part of it is showing your value. And in some cases, I've seen very substantial impacts. In this file, I more or less have Bill's income and assets the same as Sue's. So the impact is going to be, relatively minimal. So let's go to withdrawals and have a look at it. first of all, we've got to save the initial tax tactic. So in this case, we're going to talk about withdrawing from the RRSP up to the first tax bracket, and then for any additional needs, drawing from the TFSA. So we'll click the apply button and we'll apply that tactic. Now, in order to see the impact and to see whether or not it should be applied, you can see a bit of a change here. If we roll your mouse over, there's a before and after, roughly $40,000. So if we click this optimize or expand button, we'll actually see this panel, but we'll also see the impact. So you can see actually there's a tax benefit. Oh, it's actually showing a reduction in tax, but a planned difference of $6,000. So that's actually not going to work well for them. But let's go to Sue and we'll see what the impact might be for her. So again, this is a case of wanting to check the overall impact to decide whether or not that particular tactic should be applied. And this is something where you just have to go in and actually check it out. There are, substantial interconnected factors that are involved. So no linear thinking. All of the pieces of the puzzle have to be tested, so to speak, and it's a very dynamic sort of thing. So you literally have to go in and try it and then see if it should be applied or not. So in her case, a small tax benefit, and the total planned difference is the total difference on the value of her income producing assets. So in this case, we'll deselect the tactic for Bill and we'll leave Sue's selected. So that's tax tactics. The next thing we want to do to this plan, because it's house rich and cash poor, is actually downsize the house. So this is a two-step process. This is the convert tactic. So we're going to go in, we're going to sell the house in 2030. At the time, Bill's going to be 70 years old. So, we don't need the big house anymore. Now, what's going to happen when we sell the house, of course, is that all the capital from the house is going to go into the non-registered portfolio. So it's going to show a very big bump up. So we need to do the second half. It's a two-step process. So in the two-step process, what we need to do now is go in and buy the condo. And you'll notice the values that come up here as defaults are relatively low, but depends on where you are in the country. So I'm going to make this June 2nd, and you'll see that that's actually 1 day later than when I sold the house, because of course this will be a principal residence and we can't own two at the same time. And then I'll make this purchase $300,000. Bring up the income assets, and now we're going to get the impact of selling the house, buying the condo, and the net impact. And we can see here then the increase in the income producing assets, the net impact. So let's look at a create tactic. And in this particular case, our create tactic won't relate to career, but what we're going to do is rebalance portfolios. So all we need to do is go to the allocation tab, select an alternate allocation, and I'm just going to use one of the 4 strong SMAs for convenience. And whereas I could apply that new allocation to individual portfolios, have different allocations in different portfolios, I'm going to select the apply to all button and apply them to all of Bill's portfolios. So right now we'll see the impact on Bill, and then we'll go in and we'll do the same thing for Sue. Now we'll look at the total graph. Of course, we haven't completely solved the problem, but we'll do one more thing, which is to reconsider some expenses. So if we go to the Joint tab, you'll notice that I have itemized restaurant expenses. So they're spending about $1,000 a month now on restaurants. Now, one of the problems or issues, I'll put it that way, is that very often advisors don't want to get too granular when it comes to what are you spending money on. The problem is to say, oh, my expenses are $50,000 a year and I'm going to cut them to $40,000. It actually doesn't have any focus. So what change is specifically going to be made? And I'm going to suggest that if there isn't specific focus, it's very often difficult for people to actually just cut spending because they don't know where they're going to cut it. So I grant you that getting granular may not be something that you particularly want to do, but by being a little more granular, there's a very focused approach. What is it specifically that we're going to do? So I'm going to chop their restaurant expenses in half because we got to do something to try and make up this difference. And we'll see what the impact is. And then after we've done this, what we'll do is we'll go to the report and we'll see how all the sections of the report come together. So you see, again, because it's $6,000 after tax, it actually has a pretty big impact. By the way, a great deal of this shortfall in the final year just relates to estate issues, and we call that estate noise. Generally speaking, it's better to look at the situation in the year before the terminal year, just to get rid of all the estate noise. So you can actually see that from something that was a very substantial shortfall, by reducing taxes, minor effect in this plan, but nevertheless something we should include, downsizing their house, reallocating their portfolios, and then examining their spending, we've actually cut the shortfall down to a relatively minor amount as compared to where we started. So let's go to the reports. Now, the point that I most want to make is that in a report, you can select what I'll call default sections and subsections, things that you virtually want to include in every report. But rather than a report being very cookie cutter, just general cash flow projections or whatever, to really make a report meaningful for people, I think that you want to include very specific things that relate to that particular client. So in our case, what we're going to do is we've got reducing income taxes, we've got converting wealth because they're downsizing. We won't include creating wealth because we didn't touch careers. We will look at, obviously, the investment portfolios, and we'll look at conserving wealth because of the changes in spending. And I think we'll not bother with the estate issues because we haven't dealt with those in this plan. And then I think the bottom line is that we can include the net cash flow forecast, their spending over time, and we can also include the income assets forecast because it's the bottom line. Will money last? And you'll notice, by the way, that we used to have a stacked bar graph, but recently we introduced a stacked area graph, which is just a little more attractive. So let's produce the plan. And what you'll see is that in addition to any default sections we want to include, we're including sections that are extremely focused on that particular client. And so the plan for them is, I think, very meaningful. And all the pieces of the puzzle come together. So plan should tell a story, and it should be a story that relates to the client. And this is the reason why last December, we revised the reports so that in addition to what we call the default, which is kind of more like a standard financial plan, we now have this 3C style. It's very graphical, tells a story, and then walks clients through the story. So you may like it, you may not like it, but it's something that I think really is best tested out with your clients to see if they find it engaging or not. So again, it takes a second to assemble the report. We've got to populate all the text. We've got to populate all the tables. Some of the tables are actually internally doing calculations. So that's why it takes a bit to build a report. Then when we finish this, we'll unmute again and entertain questions. And I think the big question that I'd like to ask is whether or not you felt that what we've done today is actually going to be helpful in you being able to identify the core issue that somebody has, house rich, cash poor, and being able to identify, once we know the issue, what are the things that we might look at to help resolve the gaps that you have. So let's have a look at this. So I've included the 3C section. It's designed to give people this concept that really all planning tactics are one of these and fairly easy to grasp. And then, of course, what the report does is it says, well, let's take these one at a time. So let's talk about reducing income taxes. And in this particular case, the OAS clawback is going to be a factor. It's going to save $15,000 for the two of them over time. For Sue, we've got some optimization and withdrawing from different portfolios. We've got the impact of splitting pension income. And then if we move on, the converting wealth section, it shows the sale of the home in 2030, the purchase of the condo, the capital takeout net is 400, and how that 400 boosts up their income producing assets. And then if we go to the investment policy statement section, it's showing the current fees that they're paying using a standard MER mutual fund portfolio. In this case, the new proposed fees, which shows a saving of $2,000 a year, and then the reallocation of the portfolio and so on. And that's for Bill for all his portfolios, Sue all her portfolios, so it keeps it fairly light. The spending plan shows the current expenses, and you can see the lifestyle total $61,000. And when we reduce the spending on restaurants, it's now $55,000. And then this is what I think is most useful. And again, one of the reasons to be somewhat granular, we can see specifically that we need to focus on cutting our restaurant expenses from $12,000 to $6,000. So our current spending versus our proposed spending, and the changes are highlighted. You'll see there's a bit of a change in tax as well. And then we're just looking at the net cash flow forecast. So overall, the different spending, and then the income assets forecast. Will the money last? So this is showing the value of the different portfolios. We still have that slight shortfall. And then, of course, the value of the different portfolios over time. By the way, we just do the next few years and then every 5 years after that. But if you want detail for every year, in the appendix, you can select annual net cash flow all years, income assets all years, and net worth all years. But we have those in the appendix so they don't overburden the body of the plan. Thank you again for joining us today. Our intention was to simplify plans so that ultimately you see that all planning tactics are one of the 3 C's, and that all plans fall into one of 5 main themes. If you'd like to receive the 3 C's in 5 main plan themes PDF file, please contact us. Again, thank you for your time.